Hello, welcome to the Market Cover. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for just giving us a few minutes of your time. For those of you who may be just watching for your first time or are new, we do this call once a week. We send the video out on Thursday, and it's a recording of the things that we found useful or worthy of sharing from our allocation meeting that we hold each Monday. Usually we have around three topics. Sometimes we stretch it and we'll punch in four, and other times it might just be two deeper points that we dive into, whatever the matter. This week we have two for you. We're going to talk about the earnings yield compared to the Treasury yield and what that might mean for investments. And then Andrew is going to cover a technical update and look at stocks at the 3 months high. So let's dig right into the earnings yield and Treasury yield because we crossed recently a milestone. So what we're looking at here on the screen, we've got two lines going back over multiple decades. The black line is the U.S. 10-year Treasury yield. And then the blue line is the earnings yield of the S&P 500. So think of it as the inverse or opposite of the PE ratio. So if the price of a stock is 100 and the earnings is 5, the yield would be 5%. Now that earnings yield could be shelled out. A portion of it could be a dividend, a portion reinvested to buying back stock, and another portion reinvested to go back into the business to provide future growth. But all in all, that adds up to be an earnings yield. And it's not a perfect comparison because you have different features. Bonds have safety and stocks have growth, but it gives you a starting point. You can see they do vary over time. And here over the last 15 years or so, we have seen a world where the earnings yield has dominated and been well above that of the U.S. Treasury yield. And that has recently changed, and the Treasury yield has went back up higher. So if we were to zoom out, you would see many periods where this is the case. I would say we were just exiting a very abnormal period, this 15, where you had such just an enormous advantage to stock. So a couple implications from this. The first is looking backwards. When you come in and we go over your update, we list benchmarks. And one thing that has just stood out to us is over the past 10 years, the difference between that Dow Jones conservative and Dow Jones aggressive. The Dow Jones aggressive has returned over 9%, while the Dow Jones conservative over 10 years has yielded less than 2% total return. And that just speaks to the harshness or the low yields that we've had across bonds, making them an unappealing investment over a long period of time. So that has changed now. And this doesn't mean that stocks have got to be sold or they're at a disadvantage. It just means they're closer to being fairly valued across each of them. So we would expect going forward a more balanced disparity. You should have higher return as an aggressive investor than a conservative, but that wide of a gap, 3 or 4 times the return is not as likely to happen. And we can point to this chart right here as one of those reasons why that is the case. So Andrew, we'll pass it over to you to take a look at stocks.
All right, thank you, Adam. So last week during the Market Carver, if you caught last week's video, I was looking at the percent of stocks each day that were advancing. We're looking for about 75% of stocks was a really healthy, strong number. In wanting to see after we saw that 5% pullback, wanting to see a collection of those 75 up days, and we did start seeing those. We had a couple of them last week. Now that the markets continue to recover since then, we sit less than 1% below the prior high. As of Friday, we were just 0.6% below that prior high. So now we shift focus and we start looking at what are the types of environments, types of data points that we're looking for if we do continue to see strength in the equity market and we see a new high occur shortly. And so that's what the chart on your screen right now is looking at, specifically looking at the percent of stocks that are making 3-month highs. That's shown in green, and then in red we have percent that are making 3-month lows. We can see that low list didn't get quite too high, didn't even breach 20% during that minor pullback. Now we're back to hardly any stocks are making 3-month lows. But what we want to focus on is that green part, the part showing new 3-month highs. So at the start of the year, around March, we started getting really, really close to 30%. a really healthy number. Right now, we're closer to 14%. So we want to see an increase in that number. We want to start getting something closer back into the 20s where we start seeing broad participation, where if the market does break out, we see a lot of other stocks doing the same, making new multi-month highs. And that tells us that we do have a broadening out of the market, that we have a lot of support of what the index is doing. A lot of stocks are doing the same type of price action. So we're not quite there yet, but neither is the index. And so as we progress, if the market continues to move higher, we want to see this number slowly and continually increase. And so if we do hit a new high, we'll be looking at this chart probably in an allocation meeting and evaluating if we are seeing a broadening out of this market rally, or if we're really seeing just a focus on just a handful of names as a theme that we saw throughout the start of the year and throughout the prior year, where it was just a couple stocks that were really marching the market higher. So this is something we'll continue to be looking at as the market tries to recover, and hopefully we continue to see an expansion in these new high lists.
Awesome. Thank you, Andrew, and thank you to all of you for giving us this time to watch this video. As always, we give you a reminder, if we can be of service, please give us a call, 800-928-4001, or scan the QR code and book it electronically. Thanks again. Have a great weekend.